Good evening and welcome to the Shadow Trader Weekend Edition. I'm your host, Peter Resnick from ShadowTrader.net. If you recall, at the beginning of last week's program, the first thing I said was, wow, what a week it was. And that phrase would be just as applicable to the week we just had. If I had to encapsulate it into one dominant theme, I would have to say that it's the fact that when volatility rises, it cuts both ways, not just down, but also on the upside. Okay, we had a lot of earnings this week from some big heavy hitters, Meta, Microsoft, Google, also Tesla, all of which kind of pulling the market in different directions that caused a roller coaster of a week. But as always, nothing matters except what that did to the charts. Where did it leave us in terms of key moving averages, trend lines, technical events, etc. So let's go to the chart and find out what's really going on. As you know, I like to keep my technical analysis bag of tricks as small and compact as possible. We talked about this in previous episodes. 8-period moving average exponential, 21-period moving exponential, and trend lines, all of which were in play this week. Let's head on over to the S&P daily and check out the chart here and see what happened. Very, very interesting, I would say, in the rally that ensued after these earnings reports came out. It was kind of a very, very choppy week. As I was saying in the intro, we had Tesla this week, that was the first one. Then we had Meta midweek. Then we had Google and Microsoft. And as you can see from the action over the last 4 or 5 sessions, which encompass this week, it really was all over the place. There were very large gap ups and gap downs, etc. So it was a very noisy chart. But again, what really matters is how did we close and where did we go on Friday and what key levels, I often call them signposts, what signposts were kind of taken out going forward. So as you can see from the chart here, we've now moved through the 8-period moving average, which is important. That's the dotted line here. We've closed above it, but more importantly, we've also closed over the 21. And I think this is a major sort of carry forward event in terms of our narrative. I speak a lot about the narrative in my morning report, Peter's Pre-Market Perspective, which you can check out on our site. I talk a lot about narrative where you take days as they unfold and you sort of add them to an ongoing narrative. Think of it as like a diary of the market. And so what happened this week I think is important, the fact that not only did we take out the 8, but we also took out the 21, which is this one. The darker, more solid line is your 21 EMA. And in doing so, notice what the market did in terms of the S&P. We have our downtrend line here, and we literally went right to it and stopped. The rally took us right to the downtrend line. It made perfect sense that we would back off a little bit into the close after we hit that trend line. But in my opinion, going forward, I didn't think that the backing away was all that strong. I think that a weaker market, would not even have made it to the downtrend. And a weaker market would have probably moved to the 21 EMA and bounced off and came back, but it didn't. This market had some strength. It had some legs on Friday on the heels of those earnings from Microsoft and Google and took us right down to the downtrend line. Now, as far as carrying this forward in your narrative, all of this is super important going forward because if we are to stage just one day's close above this trend line next week, just one daily bar needs to close above it, you have to understand that the downtrend in the market is effectively over, or at the very least, the downtrend that started here, which is on this big day, the big expansion of range, which we talked about in earlier shows, where it kicked off, that downtrend would be over, and we would have to assume that we have some trajectory moving to the upside in the S&P. New chart. Second most important market that we look at, which of course would be the NASDAQ 100. Similar setup in terms of downtrend line above us, this week's rally taking us through the 8 and coming right to the 21. So a little bit weaker in that we haven't yet made it to the downtrend line, which is all the way here in the NASDAQ 100, but still a pretty strong showing, especially given that you've got 100% retracement here of these 3 days. This has kind of all been taken out right here. Now, the one thing that I'm going to be focusing on in the NASDAQ 100 in the weeks to come is the fact that you've got this relatively large congestion area right here, which is between 18,000 and maybe 18.2 or 18.250 in the NASDAQ 100. I'm a big believer that these areas of congestion, which are value areas, which are areas where more time has been spent, more volume has transacted, and essentially areas where the market deems prices to be fair, these areas act as magnets. So I would not be surprised with the little bit of more bullishness that I'm expecting in the S&P that we could get pulled a little further up into here to around the 18,000 level in the NASDAQ. And if we can continue to kind of churn through that area, then obviously the downtrend line is in play, and that's up there around the 18, it's going to be coming down to about 18,200, right? So that's the technical picture in the NASDAQ. Again, overall weaker than the S&P, but at the same time breaching some technical events here, taking out the 8, going up to the 21, kind of parking itself there, and we'll see what it can do next week vis-a-vis sort of in relation to that congestion area around 18,000. Okay, welcome to the play of the week. In this segment, I'm going to take an actual live trade that happened in real time in the Weekly Options Advisory or in our SquawkBox room, and I'm going to dissect it for you in the hopes that you'll be able to take away something educational from it and perhaps use it in your own trading. So this week's trade is a NASDAQ 100 broken wing butterfly, which was a DTE1. There's a little bit of a typo here. If you can see all the way to the left, it says April 22nd, but the trade actually was put on April 23rd and taken off on April 24th. And as you can see, it was a NDX BWB. Here are the strikes right here, buying a 17,730, selling 17,780, and then a 17,920. We know that a broken wing butterfly is simply where there is a long vertical that's more narrow, in this case 730 to 780, 50 points wide, and then a shorter vertical short vertical, that's wider on top of it, which is 17,780, 920. So given that that other part of the butterfly is much wider, that's what calls it a broken wing butterfly, and actually gives us a credit when we're placing. And this one's interesting because we actually put it on for a 10-cent credit, but as you can see here, it was taken off for a further credit of $2.50 and also $1.50 after that. So these are the most beautiful trades that I love to do a lot, where you can actually place them for a credit and then take them off for more credits. Let's take a look at a chart here and understand why exactly this worked as well as it did. Before I get into the chart, I just want to show you, this is the actual alert that goes out in real time. So you can see here, April 23rd at 11:30 a.m., trade was put on, 10-cent credit, and here's where it came off the next day, April 24th. You can see here, 9:40 a.m., 9:51 a.m., and 10:25 a.m. were the actual times of the exits. And why this made sense and why it worked out so well is, of course, happening within the chart. Right here is a picture of the NASDAQ 100 daily. This is a key level right here, the 17,780 roughly. This bottom of this candle is 17,765. And if you recall from what I was saying earlier, that the mid strike of this trade was 17,780, and that's by design. So let's just go back right here to where it was entered and where it was exited and why. Entry is right here on the 23rd. What do you notice about this bar? Main thing you should notice is it's a green bar. You have a very big up day. Broken wing butterflies, or any type of strategy that is net short, is always something you want to be putting on in the direction of the market. My basic MO in weekly options, what I've been doing for years and I do every day live with my subscribers, is I try to find opportunities where we can be net short. Net short simply means that we are selling more than we are buying, or if the number of long options and short options are equal, like in a butterfly, I want the parts that are sold to be wider so that they're bringing in credit to finance the part that's bought, which is more narrow. And this is a perfect example of that, where in effect we are net short, and because we are net short on the call side, it has to happen on an up day or you're not going to get that good pricing. You're not going to be able to put this on for a 10-cent credit to have the market pay you to start the trade if the market is moving down. You need those far out of the money calls to be pumped up so that you can effectuate the trade. So we purposely put on the trade here, and we're looking ahead in time. These candles here haven't happened yet. And we're looking ahead in time, and we're thinking, what type of a structure could we place where the mid strike is here around the low end here of the consolidation before the NDX broke down. So that's why we chose the strikes that we did, and notice that the next day was a gap up. And as we gap up, what happens to those lower strikes, those 730s? They gain a lot of premium while those 780s are effectually going away. And if I take you back to the thing, you can see here, $2.50 credit. We worked it, got filled at $2.50, and then we were able to close the other one at $1.50. And again, that's because we took advantage of the fact that the market was gapping up the next day. And it's interesting to note as well, which is really kind of one of the basic tenets, I think, of how these broken wing butterfly trades work, is the fact that, notice, we never even got close to the mid-strike. It doesn't matter. It's not a binary event of saying, okay, we're going to put this on for a 10-cent credit and we're going to quote-unquote go there, and if the butterfly expires somewhere in the middle, we're going to make a boatload of money. It doesn't work that way. I'm not interested in that at all. What I'm looking at is opportunities where I can put it on for free and take it off for $1 the next day, or take it off for $2, or even if I only take it off for 50 to 60 cents the next day, it's a huge win. And that's what happened, obviously, in this trade. So main takeaway on this, it's a strategy that takes some getting used to, definitely a little bit of learning curve to understand, but if I could leave you with one educational tip, it's right here, mid-strike of the broken wing butterfly, always at resistance. So look at your charts, see where you think a market may go, and consider this structure in terms of a way to sort of exploit a portion of that move, and at the same time, not have to lay out any sort of debit, so that if you're wrong in the trade, and let's say the market was sideways or down the next day, you're not losing any money. All right, check the link down below if you want to trade these types of trades live with me. I do them all the time. ShadowTrader.net/options is where I reside. And remember, you can always take a $7 one-week trial. So very, very low risk opportunity. You can trade with me for an entire week. Ask me all the questions you want, and it only costs you $7. Okay, on to what I think is my favorite segment of this program, called Should I Do This Trade? This one is going to be about Meta this week, aka Facebook, and it comes to us from a gentleman named John, who is asking us, should I do this trade in Facebook? This is an email that I received from him this week, and he says, sell a ratio spread of 1-3 calls May 3rd, 490-500 for a credit of 28 cents. And John goes on to say, my rationale is that Meta got crushed on earnings like Netflix last week, massive overhead balance from 480 to 520. To get in trouble, Meta would have to turn around, pierce the 8 and 21 SMAs, and rip to the high of the balance area. So what is John trying to effectuate in this trade? He essentially wants to know if he should buy 1 unit of 490 strike calls in Meta, and at the same time sell 3 units of 500 calls, which would net him a credit of 28 cents. Let's go over the chart and see if indeed John should or should not do this trade. Here's the daily chart of Meta. As you can see, the huge gap down that occurred on earnings came down to about in the 410s area, rallied from there, and kind of stalled over the next 2 sessions at about 446.44. Now, if you recall, John was talking about the congestion area here around 500, which I totally agree with. I think that if there is some sort of a gap fill, obviously it's going to be pulled to that area. Now, whenever you are dealing with ratio spreads, you have to think of them in one of 2 ways, and it's very similar to the entire MO of weekly options trading or any type of options trading, which is there are only 2 ways to make money in the options market. You can either collect credit or you can go directional. But the beauty of the ratio spread and of the broken wing butterfly and the unbalanced and the different types of esoteric spreads that I use is the fact that they can be employed doing both at the same time. Not many spreads can do that, but think about it. If you're buying 1 and selling 3, putting it on for a 28-cent credit, as John was wanting to do, you could be collecting credit. Or if the stock rallies up to 500, you may see yourself sitting on a $10 profit at the end of next week, right? If you're in that sweet spot at 500. So these types of trades can win a number of different ways, and that's why they are exciting. Should John do this trade? I would say yes, but I think it can also be done another way, which is the way that we actually did it live in my advisory this week. We actually went a little bit wider. I think it's totally okay to look at this area here of resistance, knowing that it's going to be very difficult for Meta to chop through past the 500, especially given the fact that it is that big round number, and you got to figure kind of in the middle of that congestion area, where is the area where tons and tons of longs are going to be looking to be made whole? I wouldn't be surprised if it's close to that 500 area. So I think any type of trade that collects credit in the weeks to come against that area as Meta tries to fill the gap is good. I think the 28-cent credit is decent. He's only going to get in trouble on his trade if there is some sort of a very hard and sharp rally early in the week that takes Meta hard from this 450 area up close to that 490, and that's what we call sort of testing the spread. So it doesn't mean it's going to turn into a loser, but that spread may expand against him in the coming weeks if you have that big rally, because that distance between the long vertical and where the shorts are is only $10. And that's why I think my trade is slightly superior in that even though I'm not collecting a credit, I'm going with the wider sort of ratio spread, looking at the 475 calls and the 500, leaving me that 25 wide, even money, not collecting a credit, but a lot more opportunity for expansion on the rally. And remember, very similar to the NDX trade that I just showed you, which was the play of the week, I don't need to go to 500 or even anywhere near it to really have that spread expand big time in my favor. Facebook next week, on a rally, filling, say, half the gap, 465-ish, let's say, 460, 465. Think about it. What's the value going to be in the 475 calls on Friday if price is only, $8, $10 away? And what's the value going to be in the 3 500 calls that you sold with, say, 1 day to expiry, 2 days to expiry? You see what I'm saying? It's all about holding that value in the low strike and decreasing that value in the upper strike. So when all is said and done, I would say, yes, I bless this trade. Could be done in a couple different ways, but overall, John, I say, yes, you should do this trade. And more importantly, you, of course, are a winner of a free month of my Trading Room Weekly Options Advisory. So, John, check your email, and I will be sending you a confirmation shortly. And thanks for playing. Time now for our #1 draft pick. This is where I share my best trade idea with you, a chart that I really like, setting up for a trade in the coming days. And this week, it's going to be American Express. Financial sector. If you recall, 2 weeks ago, first time we did this show, Sector Spotlight was about financials, where I felt they would outperform, and they have. Financials have been a little bit stronger, and American Express is our play for the #1 draft pick. Let's take a look at the chart over here. Let's move over here. We've got a daily chart of AXP, a lot going on it. Beautiful pullback after fantastic rally here, big breakout, and look at the volume. Increase in volume on the daily chart, then it continues on above the 8, above the 21, continuing on, peaking out here at about 240. And look what happened here over the last couple of days in the pullback, decreasing volume, and notice where the 8 is about to catch price, right there at just about that 232-ish level. So me personally, how I'd be looking at this, obviously there's a lot of different ways you can play it. Those of you that are just straight stock players, you don't want to get too complicated with it, you don't want to use options, look to be buying American Express on a test of that 8 EMA around 232. Me personally, I will probably be looking at what I call a risk reversal. I need to time this with the broad market. If the S&P does indeed hold the higher low that we just put in this week, and I feel that it will be continuing to rally, I will be probably looking to effectuate a risk reversal in this stock, which means that I will more than likely be selling 230 puts, and I'll put a little minus there. I'll be selling 230 puts in the next expiry, which is May 3rd, and I will be using those funds to more than likely be buying call verticals further out, say May 10th. So I'm financing with 230 puts next week and then giving myself a couple weeks of runway for the stock to rally. And I'm probably going to be looking on the upside at something like a 240, 250 call spread. And again, financing it with some 230 puts that I'm selling in an expiry that's closer to where we are now. All right, so that is the #1 draft pick for this week, American Express. Again, lots of different ways to play it, but very, very bullish chart. Got a lot going for it technically, so let's see how she goes. And that's our show for this week. Thank you, as always, for spending this little bit of time with me. Let's recap some of the salient points that we talked about in this week's program. From a technical standpoint, things are firming a bit, right? We reversed course a little bit, but more importantly, where have we reversed course through? Think in terms of those signposts. Take all of those technical events and add them to your narrative. And right now, to me, the narrative is starting to feel certainly a little more bullish than it was last week. 8-period exponential moving average and 21-period exponential moving average have been breached to the upside in the S&P and NASDAQ. And as far as the S&P is concerned, it has tested a seriously important downtrend line. If we get just one daily bar close above that line, that really has the potential to change the tone quite a bit, all right? I'll see you next week. I'm pretty excited. I've got a special guest next week that I know you guys are gonna really enjoy. I don't wanna give it away, but let me just say, he's really big on Twitter. So it's the only hint I'll give you, but I'm excited for that. Tune in next week. My name is Peter Rezicek from ShadowTrader.net. As always, coming to you from sunny Los Angeles, California, I wish you good trading, good night, and I'll see you next week.